Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey there, welcome back to the Financial Purpose Podcast. This is episode number 79. Thank you so much. I can't even speak anymore. Like we had a practice run. Thank you so much for joining us today. So I have a very fun and probably more eloquent guest today on the podcast. This is my good friend, Abran Villegas with Lazear Capital. And Abran, I'm going to give you a minute or three or whatever to introduce yourself. But why don't we just go ahead and do that, Abran? Tell us who you are and...
Yeah, I appreciate it.
Yeah.
And Dale, we've had the pleasure of knowing each other, I think, close to 2 years.
Yeah.
I was mentioning earlier, I've been dying to get on your podcast, so I'm really honored to be here today.
Yeah.
You have quite the setup. It's really impressive.
Well, we're going to have to do it again.
Yeah.
So
I love it.
Glad you're here.
Don't know about the cameras. I was told I have a face for radio, but happy to be here. Very exciting. So I work for Lazear Capital. We focus on M&A, but primarily ESOPs. We help companies sell to their employees, and there's a huge amount of benefits from a tax perspective and a community perspective for doing that. But most of my career has actually been as a commercial banker. So I spent my career helping small and medium-sized businesses to grow, to become more efficient, and to have an appropriate capital stack. And that's really what I'm passionate about. You've been a business owner. You are a business owner. And I think a lot of business owners know their space really well, but they get many times a lot of bad advice on the financial side or on the working capital side, and so it's cool to tag along to what you're doing. And I think the podcast is so important. I think for providing information in the community that folks wouldn't otherwise have. So anyhow, I think that was more than a minute, but totally honored to be here.
Well, also, and as I just learned when we were sitting here kind of prepping, Spanish folk guitarist. I don't know why we had never had that conversation, but we're going to start a exit planners band, right? We said
we are.
Yeah.
We're going to be called the Exits.
The Exits. Love it. It's going to be so much fun. So, okay. So I've learned a lot about ESOPs and things like that from you. And we have this really cool group that has been getting together for a little more than a year now. And once a month for the listeners, we get together, we have coffee. It's 10 or 11 people. They're just basically like cool people. We're doing cool stuff together and teaching each other about our respective disciplines and how to better serve business owners along the way. And so there's me, there's another great financial planner in the group, and Abran, and we've got a great banker and attorney and evaluator and ops consultants, right? So we have just a mix of people. And part of that whole thing is every month, one of us takes the education format for that month, and we can talk about pretty much whatever we want, but the whole thing is let's educate each other. Iron sharpens iron, teach each other, be a little more dangerous about what we know broadly, but also when to bring each other in to help a business owner. And so you last month had the education thing, and you did a great dive into working capital, and I thought it was really smart. And so I was hoping that we could kind of recreate that conversation today, although it's just going to be you and me. But there's a lot of really good information there, and we can take this any which way you want. So if you're up for that,
that's great.
All right,
looking forward to it.
Perfect. So kind of to start, one thing I want to do and remind me before we end the podcast is I want to have you come back because you said ESOPs, and so people may know what that is in the cursory sense. But I was hoping we could also spend just a couple minutes, like what is an ESOP? How does it work? It doesn't have to be very deep, but of course, just as a jumping off point. So I always try on the podcast whenever we use like language or acronyms, to kind of bring that down and just say, here's what this means. If you want more information, let's have a conversation, right? So
yeah, and bankers love acronyms, so I'm very appreciative.
So do anybody in financial, like anything financial, we have acronyms for everything. I had somebody the other day was like, you said the word KPIs and I didn't know what that meant. And I was like, really? So I guess that's just a reminder, like not everybody knows the language, right? So, Okay, working capital. So broadly defined, current assets minus current liabilities. That's what you have left over, right? And so current is cash that is good within a 1 year period of time, liabilities that are paid within a 1 year period of time.
Yeah.
So talk about the role of operating capital, and I guess maybe let's start with, is it fair to say, because I just working with some of the people that I work with, that is a metric that they do not know or understand, or if I say, hey, what is your working capital like? It's like, okay, let's back up and talk about it. So talk about the role of working capital in the business, why business owners need to manage it, watch it, understand it, know it.
Yeah, great questions. And you gave the definition, so I think we're done. That was awesome.
Thanks, Josh. Shut it down.
Well, so I think it's extremely important, and maybe to say I'm passionate about it is a little bit of an overstatement, but maybe not. I actually am. I think
Yeah.
if you talk to a lot of business owners, they may not necessarily understand what their working capital is or why it's important. But as you dive into the financials or look at the operations of a company, a couple of interesting things to think about. Businesses don't typically go under because they're unprofitable or because their revenue is growing. They typically go under because of cash.
Yeah.
And cash is such an important measurement of your success and also your ability to grow. Because I think what folks, a lot of times, I'd hear business owners say, well, I'm profitable, but I don't have any cash. Can you help me understand why? And so that's in a nutshell kind of the role of working capital. Cash does not equal net income very often, especially if you're growing.
Right.
And I think for a lot of businesses, small and medium-sized businesses that are growing at double-digit rates, they can get into a cash crunch really quickly if they don't understand their working capital.
Yeah. Yeah. And we were kind of deep into the conversation, and you used a really great example of Costco. And so I think maybe we can kind of bring that in, because they have a really interesting cash management philosophy that I had not seen before, right? At least not in the way that you broke it down. So that was really fascinating. But I I think that I had a thought. Sorry, I lost my train of thought, which happens sometimes on the podcast in real time, and we don't edit it, so we're just gonna go with it. We were deep into the conversation last month when you were doing the education, and you brought up the point, even though cash is important in the business and understanding how capital flows through the business, it is not the same as looking at your bank balance and deciding how to run your business.
Right.
So talk a little bit about that.
Yeah, I think, again, getting back to your original definition, current assets are anything that will be turned into cash within a year, including cash.
Yeah.
So you think about some of your businesses: inventory, receivables, some of the short-term receivables. And then on the payable side are things that you need to pay within a year. Think interest payments, current portion of long-term debt, payables that you may have, maybe accrued vacation, things like that. And I love using Costco as an example, because they have built a whole business model in my mind around working capital.
Yeah.
And a lot of folks think they're a warehouse, they're selling things, that they're a retailer. I think in a lot of ways they're a bank. You look at their profitability from last year, and about 12% of their net income came from interest income that they were earning on their cash. And that just is exponential now that rates are higher.
Yep.
But even when rates were lower, they were still earning a boatload of money on their cash. And not only that, they weren't having to borrow. So they weren't having to they were able to open warehouses and open new markets with their existing cash. So that doesn't show up in the income statement other than avoided interest expense.
Right.
So I think you really need to be thinking about what is being converted into cash within a year. I sit on a nonprofit board as well too, and we were growing at a 15 to 20% rate, but our receivables kept becoming more and more inefficient, and we quickly got into a cash crunch. So yeah, to get back to, I think Costco's a fascinating one just because I think they do it to the extreme, but you think about how they handle their inventory. So they don't have a warehouse anywhere, right? Their stores are there. That's hence the Costco warehouse.
Right.
And you look at how they place their inventory. They're not holding it in some type of warehouse and then putting it on the floor. They actually bring the pallets right from the manufacturer onto the floor. So they're very efficient, just-in-time inventory. Zada is another example that is really efficient on their inventory to the point that they have about 15 to 20 days of inventory on hand. So you think about that.
And you made us calculate that.
I did, yeah. And I won't make you do any homework,
Right,
but maybe we'll do it afterwards.
Right.
I think you were like the first to get all the answers correctly, by the way.
I don't know. I mean, it's really hard to be faster on the numbers than Kazem is.
Yeah, no, I think you beat him out this time, though. And you were
Interesting.
good. Yeah. Were you the one in the front of
no.
the class?
Kazem wasn't there. Kazem missed it.
That must be why you won.
So I think it was like, I think Susie maybe was faster than me in calculating.
I think
Anyway.
you're being modest. Yeah. You were at the front of the class, weren't you?
Hmm.
Yeah, I knew it.
It's the only place I can pay attention. If I'm in the back, I'm
At other
if I'm in the back, all hell's gonna break loose. So
Break out the drones.
it's something. Yeah, it's gonna be bad.
Yeah. But so it's incredible. They've built a whole model around holding as little inventory as they can.
Yeah.
So 15 days. You think about the receivable side then too, they're not offering credit to anyone. And that's why they have their deals with, there was American Express and now MasterCard or Visa. But their receivable days are like 2, meaning they're converting their receivables to cash within 2 days.
Which is, I mean, it's unheard of.
Incredible.
Yeah.
And then you look on the payable side. So this is where it gets really interesting. And they're able to stretch their vendors. And I don't have the exact numbers, but it was roughly, last time I calculated, you had roughly 30 days of payables. So think about that. You are turning over your factory twice. You're selling that piece of, that hot dog or whatever it is twice before you're having to pay your vendor for it.
Right.
And that just builds cash. And builds cash in a real very meaningful way. Again, one of the questions I like to ask is, what do you think the most profitable item is for Costco? It's not their hot dogs or their pizza. I really like what kind of annoys me at Costco sometimes is like I really like a burrito or something that like they have and then they like take it out after a couple months. But anyhow, they're most profitable.
Or you can find different things at different Costco's. That's really frustrating too.
It is. Or they put them in different places and then I'm walking all around.
The store's flipped.
Yes.
Yeah.
Although I don't mind that because then I get the free food twice. So that's
Well, you get your Saturday too. Yeah.
Saturday meal.
Yeah, you got to work off those calories, those free calories. Yeah.
Exactly. Yeah. But yeah. So again, think about this: 2 days of receivables, 15 days of inventory, and then 30 days of payables. So I think that I should have looked this up. I'm sorry I didn't before this interview, but I want to say they have something like $6 billion of cash on the balance sheet. Very little debt. And again, they're making 10% of their profit is coming from just the interest that they're earning on their cash,
which is insane because that is like it's a really great poster child for efficient cash management. And it's important in business to have good cash flow. Like a lot of people say cash is king, and I say cash flow is king because like in your body, blood is king. Blood flow is king, right?
Yeah.
And so blood stops flowing, the body's going to drop, and it's the same thing with the business. But within cash flow, there is a portion where you don't want to be turning over 100% of your cash as soon as it comes in. 100% of it's out the door. So there has to be cash management, and part of that's good ops efficiency in the middle. But to be able to have cash that you can remove from operations and put into something where it's going to earn a higher yield is fantastic. And that's like the creme de la creme of business success, is being able to slide cash aside.
Yeah. And one question I always love to ask business owners is, what do you think your cheapest form of capital is? So equity is probably your most expensive, right? I mean, private equity groups are expecting double-digit returns, probably something in the 15% range.
Yep.
The next would be like mezz debt or kind of in the middle debt. And then banks, you're probably charging 6.5% to 8% interest. So banks are probably cheaper than equity, but you know, your least expensive form of capital is actually working capital, or being more efficient with your working capital, because it costs you nothing to be more efficient, but it just unlocks a lot of cash. And a lot of business owners, this came from getting requests for, you know, hey, I need a $2 million line because we're growing. I need to fund receivables. And after looking at the analysis, this is probably why I didn't make a great commercial banker, but in looking at the analysis, it's not, a lot of companies don't necessarily need a larger line of credit or more debt. They just need to be more efficient with their working capital.
Yeah. Yeah. And I would say that's probably not all that different than how the average person doesn't need higher credit card balance or higher credit card limits, right? Because that'll just drive up the balance. And so I imagine in business, you know, if you give a mouse a cookie, it's probably going to go to marketing or something, right? Where it's going to give the appearance of I'm investing to grow the business, but that's not always the case.
Right. No, you're absolutely right. And then I think also, you look at, you hear a lot of business owners that say, you know, I pay my bills the minute that they come into the office, or I don't have any vendors, and my payables are really clean. Well, that's great. Maybe give your payable person 2 weeks off.
Right.
You can pay them the day that they're due and not aggravate anybody.
Yeah.
And just by doing that, you can unlock some cash.
Yeah. And we had talked about going back in and even for especially long-term relationship suppliers, you know, if you're on a net 10 or a net 15 repayment schedule and you have a good history, you can renegotiate that to net 30 just to give yourself more time to collect interest or to be able to rotate cash and then pay that invoice. As long as you have your cash flow process in place and it functions well, that extra term, to your point, can be very beneficial for businesses.
It can be huge.
And it can save the cash crunch, right? Because having to turn an invoice around every 10 days can be really problematic.
It can. Yeah, another idea is to put things on credit cards that don't charge extra fees. So I think, yeah, a lot of utilities will accept credit cards. There's some vendors that will accept credit cards with no fees. So you think about how you stretch your payables there. You're paying them the day it's due,
Yep.
right? But then you're not paying your credit card off. And this only works if you pay your credit card. I'm not advocating, you know, carrying credit card debt.
Yeah.
But if you pay that credit card the day it's due, you've stretched your payables in some instances 45 days.
Right.
And
Yeah.
so it's a great way to unlock cash, get the points. And again, this only works if you pay off your credit card every month. But it's
Sure.
and I guess I'm a big proponent of just maybe have a philosophy, or just think about what your working capital cycle is. And there are ways that you can extend your payables, make your receivables shorter, have just-in-time inventory. So I just think a lot of business owners fall in love with inventory, or they have some really good clients that they're willing to stretch their receivables on. Just give that some thought.
Yeah. Yeah. And I was going to ask where you would see business owners kind of falling into some of the same traps. I mean, you're right. Having a shelf full of inventory and lots of options looks powerful, but to the consumer it can be quite overwhelming, especially in retail. You know, because sometimes you don't need 55 versions of this one thing or 17 brands. You know, you really just need like 3 things, 4 things, 5 if you really want to offer some variety. But then they're buying those like deep cycles. And oftentimes now I especially in retail, sometimes that's a negotiation to be able to get that product onto your shelves, is that you're buying a deep bench of inventory, but you've got to be able to turn that inventory. Otherwise it's collecting dust on your shelf, literally. Right.
Oh yeah. And things go obsolete too. I mean, you're not, you know, buying Polaroid film, or, you know, maybe that's a bad example.
Yeah.
Because I guess that's become popular again. I don't know if you've seen that.
I have. Yeah. Strange.
Yeah. So maybe if you had held it for 10 years, you would have sold it eventually.
I laugh because sometimes like I'll see things that younger people are doing and I'm just like, you know, we did that in the 90s. Come on.
Yeah, I know.
And then my parents were like, yeah, we did that in the 60s. You know, or whatever. So
things come full circle.
It all comes around. Yeah.
So true.
Yeah.
No, I think you also just think about the carrying costs of inventory.
Yeah.
So maybe that you've already paid for the inventory, but you've got to keep it in a factory that's taking up space. You've got to make sure that it's safe. You've got to have air conditioning, and then that's not turning into cash. So not only is it like opportunity costs for carrying it, but then you have opportunity lost causes for not turning that into cash, and you may have a line of credit that you're having to pay interest on. You may have other products that you can't fit into your factory, or you're having to open another warehouse because you have enough. So I just think really spending time thinking about your working capital cycle. And I say working, I mean, some people might have like a lazy capital, but hopefully your capital is working for you.
Yeah.
But I just think thinking about, and also what we can help look at too is just what are your peers doing as well. So at a minimum, you should at least be having the inventory, receivables, and payables that your peers do.
Yeah. Yeah, that's actually a really good point, because that's good benchmarking, right? So how's your business doing, right? So what are the key performance indicators, right? KPIs for your business and industry-wide. I mean, you can get industry data from any of your suppliers. They'll have that, and they'll be able to help you gather that. Or you can Dun & Bradstreet, or there's lots of different ways to get that information. Heck, you can probably at this point just throw a good prompt into ChatGPT and get the information you want, right? But you should be benchmarking your business, not only to know how well you're doing, but how well are you doing against your peers. And there's a lot of strategic reasons to do that, not only just for like the normal competitive, placement and how you price and market and things like that, but you may very well find that one of your competitors is either knocking it out of the park and you can go learn something from them, because there's nothing wrong with taking a competitor to coffee and talking shop, right? Contrary to popular belief, there's nothing wrong with that. You might also find that there's a competitor that is very close to having to close the doors, and you may be able to go in and have a strategic acquisition. And, there's a lot of really cool things that can happen there.
Absolutely. Especially if you have a lot of cash, right? Because you're
efficient.
because you're efficient with your working capital.
That's right. And if you're not, then at least you'll have some good checkpoints on, okay, here's where maybe I have opportunity to improve. Here's some things that we can do to tighten this up, or to ramp it up. And these are not overnight fixes. The putting the pieces in place are kind of overnight, but it's going to take some time to show the results. So how do you suppose most business owners would get that information and know what they're working with? Because a lot of times, like you and I can pull, P&L balance sheet and cash flow statement and be able to pick this up pretty quickly, or throw it into a tool and it's going to give us a good risk analysis. How does the average business owner do this? How would they do this? How would they know?
So I like using days on hand, just because I have a simple mind.
Yeah.
And those are part of the calculations that we did as well too. Because as you're growing, the problem with saying, and I think, did you post a piece about the percentage versus the number drop in the market recently?
Oh, yeah.
Yeah, that was really interesting. So it was, I don't know, like 30 points back in 1930. And then anyhow.
Yeah, well, what the value of 1% is, right?
Exactly.
Yeah.
Yeah. So that's why for me, days on hand is much more important to look at on a year-over-year basis than actual numbers. Because if you look at actual numbers, payables at $1 million, well, what does that necessarily mean? Well, I was at 500,000 last year. Well, what does that mean? So you need to look at it relative to your sales and where you're at in terms of your revenue. So I think an easy way to look at it is to take your revenue and divide it by 365, and that becomes your sales per day. Or you can take your cost of goods sold and divide that by 365, and that becomes your cost of goods sold per day.
Yeah.
Or expenses.
And fun fact, that's a really good way to just kind of start the year with a good run rate, right? So where were we last year? Divide by 365, what realistic growth rate do we expect? And you plug that into your numbers, and that should be your, how you're going to be able to get your compounding annual growth rate. But at least, because sometimes it's just like, I see in my business experiences, like, what did we do last year or last quarter? Okay, add 10%. That's our goal for this year. That's not really goal setting, right? That's not really business management. That's setting your salespeople up for a really nasty cycle. Yeah, I think.
I had a lot of bosses that did that to me all the time. Yeah. You did great last year, 10% growth this year.
Exactly. Yeah.
No, you're right. But I think if you look at it in terms of days, then a good so you've got your sales by day. If you take your receivables and divide that your receivables by that number, that gives you your receivable days, and then you can compare it to last year or the year before, and then that's where you can aim to become more efficient on the receivable side. And I'll talk about some ideas on how to do that.
Yeah.
On the inventory, you want to divide it by your cost of goods sold per day, and the same on the payables. And I don't want to complicate things too much, but the reason you use cost of goods sold is because you're buying inventory and that's running through your cost of goods sold. It's not running through your revenue. It should be.
Yeah. So that's one place where I see a lot of kind of funky maneuvering is what goes into cost of goods sold versus what stays in G&A as an expense. And that really gets interesting for a lot of companies.
It's real interesting. Thanks. Yeah.
Oh, yeah.
Yeah. Your Lamborghini probably should go in cost of goods sold. Yeah. Nice. That's some interesting. But as long as you're consistent, I guess, with that, with those calculations, over time you can see where your payables days are or your inventory days are. And I think then just stepping back and thinking, for what I'm doing, do I need 300 days of inventory? Jewelers, for example, usually have a lot of inventory, usually 1 year. But if you're a Costco, I mean, is 15? How do I get down to 15 days? And again, you can do the quick calculation to see what if you improve by 5 days, what that means in cash, because you just multiply it by your daily cost of goods sold. It adds up really quickly.
Yeah, because if you can turn over your inventory one more time a year, that's a whole nother cash cycle.
It is.
Or 2 more times a year. And sometimes even just this. So this calculation is really fascinating for me because sometimes it can help a business owner identify which SKUs or products or whatever they're doing really aren't as high selling or high velocity as they think. And they can even compare that to another vendor or, another product or something like that. And sometimes it helps them sometimes you just have the wrong thing on the shelves.
Sure. Yeah.
Or it's sometimes it's not priced appropriately. Maybe you're getting too much margin, or if it's turning too fast, maybe it's priced too low, right? So you can kind of play with that to move your turn time.
Yeah. And I know, Costco, for example, I fall in love with these burritos and then they don't have them 2 months later. But I know it's because they don't, because they're only leaving things on the floor that turn quickly.
Yeah.
And that's important to them. So they're looking at that very closely.
I think you just need to buy more burritos and then come back.
I know. I'm really, there's these ones in this like paper wrappers.
You want to go in together?
Let's do it. Yeah, let's do it. Maybe I should go to maybe I'm going to the wrong Costco. That would be it.
Yeah. Let's check it out.
Yeah. But it's a fun, and so a couple of ideas on the receivables side.
Yeah.
One is to you talked about offering discounts. That can be one that you offer to your customers. If you pay me in net 10, you get a small discount, and that can be a quick calculation based on how much cash you have or how much cash you need to see if that makes financial sense. One other is to accept ACHs instead of checks. So make it easier for your clients to pay you quickly.
Yeah.
Or get authorized to debit their accounts for monthly fees that they may charging. And by the way, this applies to service industries as well, too. It doesn't mean that you have to have inventory because all companies have receivables and payables.
Right.
Some have inventory, some don't. Our business doesn't have
inventory,
but we do have receivables.
Yeah.
And I think just making it easier for your clients to pay you quicker is helpful. And then on the inventory side, couple thoughts there. One is instead of, if you're buying goods from overseas, instead of paying 50% up front, some companies, some manufacturers will accept letters of credit. So that's a lot less expensive. You pay through a letter of credit, you get the goods, and then the cash comes out of your account. So that is a way to conserve cash as well.
Although now that's potentially a more expensive proposition.
It could be 40% in some
instances.
Yeah.
Depending on how where you are.
About anything?
No. No, I'm not.
Yeah, I lived through COVID, and I still have like that mentality. I better buy, bunch of stuff. So and I think it's still, and I'm not taking my own advice on, not keeping too much inventory, but
no, I kind of like, I very much am, let me see what's happening around me, and then I'll make those, decisions in flux. So maybe I'm the one who's not very smart because because I'm buying when there's higher demand. So now there's a higher price and there's less available. And
Yeah.
I don't know.
Who knows? Who
Yeah.
knows? But I do know you can control your working capital cycle, and there's
Yeah.
ways to do it. And I'm just advocating to just be more thoughtful about how you think about not just your business or what you're selling, but how you're collecting your money, and then how you're paying out your bills as well too.
Yeah.
And again, there's nothing wrong with paying right on the day that that a bill is due. I try to do that with my credit cards, pay them off the day that they're due, not beforehand. Especially in this environment where we've got what three? I think I'm earning close to 4% on my savings account.
Sure.
You can earn a lot more interest on your cash than you could 2 years ago.
Just let it sit.
Yeah, just let it sit.
Yeah.
And that's extra money that you don't have to lift a finger to do in terms of selling another product or
Right.
gaining a new customer. It's just being more efficient with the things that you have.
Yep. And that's one of the things that I wanted to come back to is because you had said, if you can get your customers to pay you inside of 10 days, give them a slight discount for that privilege. Because it really is a privilege. Like, you can pay me in 10 days or anytime between now and 10 days, and it's a privilege, but I'm going to give you a discount, turn it in faster, right? Or you shorten them from net 15 to net 10 or something like that. So if you increase the frequency that you're being paid, then that's longer you can sit on the cash before you pay then somebody else, right? So that's like the game strategically that you can play.
Float, yeah.
Yeah.
And it's funny, there used to be, so when I first started in banking, there was this product, I forget what it was called, but essentially you paid a little extra so that when you wrote a check to someone, it would actually clear through this small bank in South Dakota that they got snail mail. So it would clear in like 10 days instead of the normal like 3. It was a way to extend your cash. But after 9/11, everything became electronic. So there's no float doesn't exist. I mean, if you write a check today, that's out of your account like in 1 or 2 days.
Yeah. My very candidly, my very first financial lesson was when I was 17 and I had a checking account and I wrote a check to pay for something stupid like a coat or a pair of jeans. I don't know, something dumb. Wrote the check, whatever, and sent it off, did whatever, you gave it to the cashier, whatever you did back then. And then I spent the money in the account some other way. And I didn't realize the clearing process, right? So I had to sit down in front of the banker, and the banker's like, "So you bounced a check?"
Yeah.
And I'm like, "I don't even know what that means." So I had to learn that pretty.
Yeah, I had a family member who she said that she didn't understand why there was no money in her account because she still had checks.
That's a classic.
Yeah, it was. We had a good conversation.
Yeah, that's a good one.
But yeah, so this is the modern day float. So you used to be able to play games with checks and float, but this is a way you're thinking about stretching your payables where you can, shortening your receivables where you can, shortening your inventory days when you can. It's really vital. And again, it's compounded. This is compounded, Dale. Think about this if you're growing. So using round numbers, let's say you've got $1 million in inventory and $1 million in AR. If you're growing by 10% and not changing any way that you collect, that's another 100,000 in inventory and AR that you have to invest in your company.
Yeah.
And if you have 5% margins, then that's 100,000 that you're going to have to borrow. Whereas if you could shorten your inventory days or shorten your receivable days just a little bit, you may not have to borrow to grow that 10%.
Right. Yeah, and that is challenging though, I think, especially for fast scaling businesses are the hardest ones to run operationally effectively. And that's why, somebody like Kimberly or Kendi, who's in our group, need to be involved in those businesses, because the faster you're going, the faster the money is coming in and out. And that's where you can really dry up liquidity really fast. And sometimes it's just as simple as hiring somebody vastly changes that, or buying a piece of equipment, or jumping on a marketing thing or sponsoring something and not really paying attention to where you are in your sales cycle, your receiving cycle. And so
yeah, and I think we're talking to you, talking to Candy, talking to the folks in our group, it's just really it's helpful.
Yeah, it is. I mean, because the game of business, it's a hard one to play, and it's even harder to play correctly. And a lot of times you do get conflicting advice, and so sometimes what looks good for tax sheltering isn't good for operations efficiency and cash management, and vice versa. And so you've got to make sure that those things are all uh, in concert, right, with one another, where they're all playing from the same sheet of music, I guess is a good way to say it.
Yes.
Um, because often they're not.
And think about this. I mean, I've heard the quote, I'm so excited I got a contract with Walmart or Costco. And then the next day it's like, oh, shoot, I got a contract with Walmart or Costco.
Yeah.
For a couple of reasons. One, they're going to require you to invest a bunch of inventory
Yeah.
and then not be paid for 30 days. And you think about that for like a manufacturer. Well, you've got to hire the people, you've got to have the factory, you've got to buy the food, you've got to buy all of the inputs, you've got to pay your employees before it's even shipped. And then it's shipped, and then you have to wait 30 days to be paid. So in a lot of instances, it's taking 90 days to convert that inventory into $1 in your checking account.
Yeah.
And again, if you're growing 30-40%, that's a lot of cash that you're going to quickly just burn through. And if you're not paying attention. The other advice I'd give, and it's somewhat tangential to tangential. Did I say that right? I'm getting tongue-tied. To working capital.
Yeah.
That's good. Thank you. Is the having a line of credit. So I see it like it should be a backup, and I see it like insurance. Once you need insurance, once your house is burning, it's too late to get a policy.
Right.
Get a line of credit or have some liquidity available before you need it, or especially if you think you're going to have a big growth spurt, you should have that line of credit available to help with your working capital.
Yeah.
First, be efficient with your working capital, and then second, have a backup line of credit in place for that growth.
Yeah, and I would add to that and say that for you to be able to get the line of credit, you're going to have to look good on paper to an underwriter at a bank. And that means you're going to have to run your business clean. And so I've talked several episodes about how to separate personal from business and make sure you're not piercing the corporate veil and doing all these things that not only hurt you from a liability standpoint, but hurt you from even the ability to get lending or to transfer the business, right? Because if the business on paper has no transferable value, you're gonna be discounted if you try to sell the business, or you may not be able to do an ESOP at that point. And there's a lot of limitations to not running the business correctly. And so there are things that you're going to have to do, like not live out of the business and not, run everything you can and not go buy a piece of equipment because you notice that there's profit on the P&L at the end of the year. Like there's things that you're going to have to do well to be able to run your business well, to be able to have the availability of a credit line so that you can run the business well, right? So it's all cyclical.
No, it absolutely is. And I always tell business owners too, you think about, so you ran some expenses and saved a little bit of taxes, but you've really dinged your value. So you think about that 100,000 that you ran and expenses you ran through your business. Well, that could have been worth 600,000 in value, but you saved, good for you. You saved 30,000. So
Right.
30,000, 600,000 in value. So it's just things to consider. And some business owners aren't interested in selling, and I get that. Then no one likes paying taxes. I get that as well. But you're right. If you want to grow your business and run it efficiently and have the debt available to be able to be efficient and to be a good candidate to sell, hopefully as an ESOP, then you need to run things correctly.
Yeah. So perfect segue. ESOP. What is it? Briefly explain it.
Yeah. No, I appreciate that.
Fly over. Yeah.
Super passionate about working capital and super passionate about ESOPs. Two things that I care most about, and my guitar playing.
Yeah. Right.
So couple statistics in Arizona: 70% of business owners expect to sell in the next 5 to 7 years. In Arizona in particular, the statistic is 80% of businesses that sell to out-of-state buyers. So just think about that. If all of these corporate headquarters were to sell to out-of-state buyers, and a lot of times it's their competitors out of state, or it's a private equity group out of state, that could be pretty devastating to our economy.
Sure.
So that's why an ESOP actually keeps the company here local, and we're able to benefit the employees that are here. A lot of times the back office are the first to go because that gets consolidated into headquarters. So it's keeping good paying jobs here.
Yeah.
The cool thing is it's not a zero-sum game. In most cases, for business owners and sellers, they're actually able to get more cash out, after-tax cash, than they would to a third-party sale. Contractors in particular, were usually able to get them a higher value than they would get in the open market selling to a third party. Plus, they're able to sell tax-free. Plus, now they're able to attract and retain really top talent within their workforce.
Yeah.
The one downside, and this is, again, it isn't for everyone, is that typically it's a 3 to 4 year payout for the owner, and so it's not an all cash offer.
Yeah, but there's some significant capital gains defer capability with that, or elimination, as you just said, right? So, depending on how you do it and how well you've done your tax planning and whatever, but it requires good working capital in the business to make the ESOP function.
That was good. I like that tie-in. Really well done.
So ESOP stands for
Employee Stock Ownership Plan.
Perfect. And so that is often we would refer to it as an employee-owned company. So what would be a good example of a company that we would all know that is ran by an ESOP?
So a couple of large contractors here, Sunt and Kitchell, have been ESOPs for decades.
Yeah.
They have these great stories about these like forklift operators that retire with $4 or $5 million in the bank in their ESOP. So cool that you're creating wealth for folks that wouldn't otherwise have it.
Yeah.
I have an uncle and brother-in-law that work for Dunn Edwards Paint, which has a few stores here in the Valley. They were an ESOP. They got sold, and it was transformational for my family members. So I see on the back end where it's really special what you're creating. Plus, you're protecting your legacy. You're keeping things local. We're both part of exit planning, but there's another statistic that they have that 75% of business owners deeply, not only regret, but deeply regret selling their business after a year. And a lot of that is because they lose their sense of purpose.
Yeah.
Or they're having a good time cruising the world, and the 100 employees that got them there aren't able to participate in that upside. They lose meaning as well. And ESOPs are a way to continue to have that meaning, to continue to give back to the community, and to continue your place in the world. So,
yeah, and I think they also it's really a great way to sharpen your culture, your business culture, your company culture, because everybody then has a vested interest in its success, and it's a great way to kind of turn the us versus them thing that often happens, with business owners versus the employees, because I see that I had somebody comment on one of my videos a couple of weeks ago where because it was like a clip, and it said something like, one of the loneliest and hardest roads to walk is that of a business owner. And the person was like, yeah, right, get real, business owners aren't blah, blah, blah. And I'm like, no, like really, it's tough. It's tough.
Yeah.
It's tough because there is no guaranteed paycheck when you own the business, right? There may be times where everybody else gets paid and you don't.
And often ones with their house on the line, they're personally guaranteed.
Oh my gosh!
I mean, it all falls on their shoulders.
Yeah, oftentimes they're cashing out any 401k or any IRA that they have to fund the startup of the business, or they're squirreling cash or selling personal assets. I mean, yeah, it's not easy to run a business, and it's certainly not easy to run a business well.
No, you're absolutely right. And it's not easy to leave a business too, because I think there's a lot of business owners, entrepreneurs, this is their second family, and this is their passion. This is a lot of times who they spend more time with during the day. I've been surprised that, I was touting, you could get more money after cash benefits, and, the ESOP pays our expenses. There are a lot of cool things that can happen. Most business owners who are passionate about their employees just love the piece that they're actually helping them.
Yeah.
So that's my 2 cents for the day.
That was a little more than 2 cents. But no, I think it's helpful. So, I told you that 45-ish minutes would go really fast. And
It did. Super fast.
Super fast. And here we
I
are.
think it's because you're super charming.
No, I think it's because you're smart.
It's definitely not it.
Well, so anyway, let's do this. So, business owners who have questions about exit planning options, usually they're going to run into someone like me, someone like you. There may be a business that's like, I don't even know what an ESOP is. I don't know how it works. I don't know how to do that, whatever that is, sell my employees or sell my company to my employees. I don't know what that means. So how would somebody reach out to you for questions, more information, initial conversation? How does that process work?
Yeah, so my dad is a teacher, and I always felt guilty about not going that route. So I'm passionate about teaching. So I love just speaking to business owners about what their exit options are. They can reach out to me. They can reach out to you. It put my email address.
Yeah, we'll put your information in the show notes.
Awesome. Yeah, but please reach out. I love talking to folks. We'll do a free feasibility analysis for qualified clients, so it won't cost you anything. And anyhow, it's something that you should at least consider as an exit option.
And what happens in the feasibility analysis? What does that look like?
So we do a full working capital analysis, especially for contractors.
Yeah.
We look at comparing their margins to their peers, and then we come up with what we think the value of an ESOP would be for them. And then we look at the structure and show them what it could mean for their employees, what it could mean for their management team. So that's really powerful as well too.
Yeah, and if I'm correct, that what value you come up with, there's a business valuation involved. It's fair market value is what the company gets sold for. So there's you really can't negotiate that up or down. I mean, it's fair market value, and it's certified every year.
It is. That's correct. Yeah, I should get my words right. If Flora is out there listening,
Oh, yeah.
she's another member of our great group, valuation expert.
Yeah.
But yes, annually you get a value, and that's where you derive your a share price from every year.
Yeah, perfect. Okay, so definitely, if you have questions about ESOPs, exit options, reach out to Abran. The information's in the show notes. You can always reach out to me. I can get you to Abran. Because I'm not going to try to talk to you about ESOPs. It's not what I know. I know what they are, and it's not what I do every day. So, but working capital analysis, definitely, by all means, reach out, get help, get the help that you need. One of the hardest things to do as a business owner is ask for help because we're so fiercely darn independent. But you don't know what you don't know, and there are really good people who are available and willing to help you get to where you're trying to go. And it really just starts with understanding where you are today. So I think that's it.
It's awesome.
That's where we are.
Yeah,
so
thank you so much.
Yeah, thank you. And thank you for tuning in. And until next time, go be a boss. Go be financially awesome. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.